Alright, we're going to get started now. Alright, so now we can see, we're forming a downtrend here. And we can see that, right now we're at the 23.6 Fibonacci. We're using the minute 15. Let me just make this a little easier to see. We're using the minute 15. We're seeing that price kind of stay along this, 23.6 area for the last, we'll say, 3 to 4 hours. And now we're starting to form, coming back towards that 38.2. So now this is where the cloud comes into play. So obviously, if we're trying to sell and we're looking to only sell at the 38.2 through the 61.8, we'll come in and, just take off, our 0, our 23.6, our 78.6, and our 100, and be left with our 3 levels like, it had formed in the beginning. And when we come in and we start to, label off these levels, we can simply, just to not have too much clutter on our chart, just come in with a simple horizontal line and say, okay, this is where my first sell limit would be placed. Here's where my second sell limit would be placed. And here would be where my third sell limit would be placed. And remember, as we go up, the Fibonacci, or as we increase in price towards our, our level of 61.8 being our last entry, we want to scale in. So we want to use a, write it out for you so everyone can see. We want to use a 0 point. If you're using, $500 account, or $300 account, $1,000 account. I'm just gonna, for the sake of this, pretend we're using a $1,000 account. We use a 0.01 right here, so 1 mini lot at this entry. We come again and use a 0.02 here at this entry. Or, sorry, a 0.2 rather, not a 0.02. That would be if you're using a smaller account than a $1,000 account. We'd use a 0.2 at this level. And then up at this level, we would use a 0.3 or 0.3 if your platform needs the one's place to be filled. It's the same thing. So now that we're scaling into the position, we're increasingly as we go from here to here. Let's just say this is roughly 19 pips. We're going to see a negative $19 when we get to this area. But as we come back down, we're going to be positive $1 essentially by the time we get to this area, because as it comes down 19 pips, well, it'll be $2 multiplied by 19, so you would get roughly $40, $38 to be exact, coming back down, and you would only have this negative 10 to take back, or negative 19 to take back, so you'd actually be positive 19 coming back, as opposed to while you're going up you were negative 19. So you would already, instead of break even by putting in another 0.1 here, you would already be positive, $19 because you essentially doubled your position. And then obviously, we also need a place to get out in loss. And some people use the 71.6 on the fib. Me, I don't like to use, or 78.6. I don't use the 78.6. I like to use my eye because obviously your eyes are your best indicator. So I just come in and I look at what are my most recent resistance points, and we can see here we get some resistance historically looking back at this area right here and right here. We also see there's an intermediary resistance point that formed within the last few days, and we'll just use a horizontal line from point right here. Make that a little bigger so you guys can all see that. Let's go to orange. Nice fat orange line. You can see this nice intermediary resistance point forming here. So it's safe to say that we'd like to have our stop loss somewhere set in this area right here between these two resistance points. Then to get that out of there, we just simply clean up our chart a bit, because it's always, that's one of my things I always preach is don't have your chart, too cluttered with indicators and horizontal lines and all these different things. You want to make sure that you can actually see your charts. Just bring that back in here. So it's really safe to say that we'd like to keep our stop loss right above our our area of interest. And to place our stop loss, we'll just put a nice little horizontal line, make it nice big and red. the fibs. We'll do this. Alright, so now we've got our entries, sell limit, sell limit, sell limit. So these little black lines here are sell limits. We've got our stop loss set, right here at our in our zone between our resistance at this area and our resistance here. If you want to risk a little more, you can set your stop loss here. If you want to risk a little less, set your stop loss here, whatever you're comfortable with. And then obviously we're going to look to see what is a pattern that's forming, what is something that we can see being, indicative of a bearish, downturn. We already see the downtrend. We see these fib levels, lower highs forming here. This here is something, to take into consideration because this could be a possible reversal of the trend, but I'm going to get to that with the Ichimoku cloud to really signify if this is indeed a reversal or if it is just, some noise on the chart. So now that we have our stop loss, we have our sell limits in place, we're almost there. Now we need a place that we get out in profit. So there's a tool we use for that called a Fibonacci expansion. We simply just take it from, the same way we do it, swing high, just swing low, the same as we do it with our Fibonacci. But this time, instead of just leaving it at that, you'll notice there's a third point here that needs to be plotted. And this third point is essentially saying, okay, where am I entering? Because what this is calculating is, okay, what is the area of this entire move? And then where did it retrace to? So now that you have your retracements already in place with your Fibonacci retracement tool, these are your speculated retracement zones here, these black lines. Now you need to see where should be my take profit for these different retracement zones. Now there is, some people do use, since this was the 38.6 or 38.2, you would put a 38.2. Me, I just like to keep it the way it is and use the 61.8. And as I move my third point, you'll see that the 61.8 rises in value. So what we'll do here is set up a take profit for each of these positions. So we're going to say, okay, if this price retraces to this zone, I'm going to set up my take profit to be right here, and I'll make this green to signify a take profit. Okay. All right, so that's zone number 1. And if I retrace back to this zone, I'd like to signify that this would be my area to take profit, right at this zone. And if I retrace to this area, I'd like to make this area right here my zone to get out in profit. Then just clean this up. So now we've got a full 3 orders set up, speculated. So now, with our great platform, we can simply come in, right-click, set up a sell limit, place the order, right-click, set the sell limit, place the order, right-click, place the sell limit, place the order, then we come in, clean out our horizontal lines, so we like to keep the chart nice and clean. Now we simply come in here, drag our stop loss right to this area, okay, click our sell limit, drag our stop loss right to this area, click OK, click, drag our stop loss right to this area, click OK. Now do the same with our take profits, and you'll just, you'll get better at it, but you'll just know that the higher is with the highest. They're each respective of each other, because remember, as we drag that third point, that 61.8 was, rising. So we drag this take profit to this zone. We'll drag this take profit to this area. And then finally, our last take profit, drag it to this area. And now you've got your sell limits, your take profits, and your stop loss all set up. Now that we have all that set up, now we're going to come back and really, it's always, you can never be too safe in the Forex market. We'd like to come back and actually see what is the probability of this trend continuing, and what exactly is the trend doing. So this is where Ichimoku, or Ichimoku, Hayanoku, whatever the name is. It's a long Japanese name. It's just, the cloud. This is where this comes in. So you got a few different features and factors here in your Ichimoku cloud. The first being your Tenkan-sen line. This is an SMA, or a moving average, rather, not a smooth moving average, but a moving of the last 9 periods. And this 9, 26, and 52 My blue line will be my Tenkinson line. My red line will be my Kujinsen line. Sunoku, I always like to make it off color, so I make it white. Span A, I usually make this green. In my span B, I make this red. The reason I do this is when your Tenkinson line crosses above your Kujinsen line, it's a buy signal. But for this buy signal to be proven, you have to have span A above span B. And whenever span A is above span B, it'll produce a green cloud, indicative of a uptrend rather. So with span A being above your red span B and your blue Tenkinson line being above your red Kujinsen line, that's a buy signal. On the opposite, if your Kujinsen line rises above your Tenkinsen line, that's indicative of a sell. And at the same time, you would like to have that double confirmation coming from your span B crossing above your span A, producing a red cloud. So without further ado, I'll let you guys see that. We'll add this to all of our charts. And you'll see these, little clouds forming, these green clouds, red clouds forming. You'll see that this red and blue line crossing and whatnot. So what we're seeing now is exactly what we were, speculating. We're in a downtrend. We can see there's a nice fat red cloud here. You can see here there's a little bit of pressure coming up. And just a few things to note about the cloud. Inside the cloud, and every time I go over it, you'll see this highlighting, but inside this blue area here, whenever you're inside a cloud, whether it's green or red, you're usually going to have some sort of price consolidation. The reason for that being is that the top and the bottom of the cloud usually serve as a support or resistance. It's not a hard support or resistance, and it usually should be lined up with some sort of support or resistance based on the chart. But if you come in and you look, you'll see that the price, it'll come usually and sit around, and if it breaks through it, it's usually going the other way. So you can see here, we were in an uptrend, we're just trending upward, breaks through the cloud, closes below the cloud, and as soon as it closed below the cloud, we got a sell signal. Go back to that area so you can see that more. You can see right here that your Kujinsen line does in fact rise above your Tenkinsen line, your red line rising above your blue line, and then that's definitely a sell signal. Because it's just a fact of how quickly it broke through the cloud. That right there is enough to say, okay, we're selling. Obviously, you can tell if without this indicator on the board, a lot of people would probably be buying right here just because of this very long wick that's seemingly working the shorts and working the longs to try to take this, to the top. But you can see that the trend continues lower and lower, and we got a continuation from this area of about 94 pips. Now you can see we're in an area of consolidation, and it's just within this cloud right here. You're seeing that your Kujinsen line rising above your Tenkinsen line, or your Tenkinsen rising above your Kujinsen line, and you can see that would in fact right here be producing a buy signal. What we're getting now, and you can see it forming real time, is you have a doji here, and you're starting to see that this trend that this straight or NZD USD is trying to push lower. You can see that it has 2 or 3 candles bullish, bearish candles take it right back. So the bears are very strong right here. Some of you could use RSI, some of you may use bear momentums. You can use those indicators, but really the best indicators to use are your eyes. And obviously we would like this to be pushed higher because this is where our sell limits are. And you can see that based off of our Fibonacci, our sell limits are right on point with this cloud. You can see right here it forms a resistance. Our sell limits right here. You can see right here another resistance is forming. We have an entry right at this area as well. And you can see also right here, where the cloud forms a resistance, that we have our last sell. So when the Fibonacci's and the cloud are matching up, that's a great indicator that you have excellent positions on board. And then when you also see the chart forming, right here resistances, right here you can see a resistance that formed a bit. You can see here that in this area the price got pushed back down, and you start to see visually, okay, these are entries that I'm comfortable with. That's also a great indicator that you're onto something very great. So kind of just to refresh over Ichimoku, when you're inside the cloud, you're usually going to be seeing consolidation, and you can see right here, went inside the cloud, consolidated. Up here where we were inside the cloud, we were consolidating. Over here we went inside the cloud, we were consolidating. Here, you can see it, time and time again, as it enters the cloud, it starts to consolidate. Consolidating, sideways movement, congestion, whatever people call it. It's just the price moving in a very small range. You can see here, it looks like it's just trending upward, but really this movement is nothing but a mere, we'll go swing high to swing low here. There you go. It's just a mere 47 pips. And for this period of time from August 4th at around 6:15 all the way until August 5th at 4:45 in the morning for it to move 47 pips. Imagine sitting there for, roughly 10 hours just sitting there watching the price move for only 47 pips to then just be taken back. It's 96 pips. So that's what's going to happen when you're in the cloud or when you touch the cloud. So a good rule of thumb is when your price either enters the cloud or it's about to enter the cloud, don't get into any trades unless there's some news coming out. News obviously is going to take precedence over all indicators because news causes the market to move depending on its impact. And if we go to our calendar really quick, we can see that high impact news is symbolized by a red exclamation point. Medium impact news is symbolized by a red or orange exclamation point rather. So with that in mind, you want to use your indicators, but always use common sense. If NFP, Fed rate decisions, some sort of thing that if you're trading euro dollar, ECB, anything like that, obviously you want to take into account those news events before using the indicators as your sole purpose of speculation. But when you're placing trades and you're using the Ichimoku cloud, you want to make sure that when it enters the cloud, you're not in a position that's too close to the cloud. For instance, if we had entered a buy right here, we would be pretty upset because we're just about to enter the cloud. Obviously, you can see that this price is anyone looking at this on a naked chart is like, oh yes, we're definitely going long right here. It breaks past this resistance point, 2 full bodies. Oh man, we gotta go. But now they're frustrated because now they're consolidated in this small area. And if you would have had this indicator up, you would have known that it was heading into the cloud and that it was consolidating. Consolidation was soon to come. So a good rule of thumb is to wait to get a signal here from your Tenkan-sen or your Kujin-sen line crossing again. And once you get a clear cross of one or the other, that's when you want to take the pair another way. So another good rule of thumb to use is wait for your lines to cross. Don't go and try and get in when your lines are too far apart, your Tenkan-sen and Kujin-sen line, because usually what that means is the move's already happened, or that means you're heading into consolidation. So for instance, we can see here we got a cross. As soon as we got that cross, we got some nice movement. But now that the lines are very far apart, you can see it consolidated for about 10 hours or so here, just in a small range. Went up, came right back down. Then we get another cross. As soon as we get that cross, we want to sell. Then we get that real movement back down. So that's the way you want to trade. And then obviously you want to take into consideration that your clouds do serve as very, very intermediary supports and resistances. And from that, that's really what you want to use this indicator for. So with that, it's about 30 minutes in. I'm going to switch it up here and apply this, kind of apply everything I just did step by step, from the Fibonacci's to the entries, but on a different pair. We'll go with Australian dollar, US dollar here. And I'll explain, step by step as I'm doing it without too much explanation. I'll just, say, okay, I'm putting my Fibonacci's, or, putting this or putting that. So first things first, I'm going to come out to my hour 4, just to kind of look and see what the trend's doing. Say, okay, we've got a clear break here downward. We got an uptrend forming here. Just to kind of, it's just a habit of mine, always drawing in a trend line to make sure. You can definitely see trending upward. Breaks trend. Here we get another trend upward. We're starting to form lower lows, so it actually safe to say to start here. We haven't quite broken trend yet, but we're gonna call this bearish because we know that this goes kind of higher level correlation trading. We know that the New Zealand dollar and the Australian dollar are usually correlated. They usually move similarly, and just to kind of prove what I'm saying, I'll overlay here. Don't take this as a step. This is just something to show. You can see that they're usually tightly correlated with how they move. So what we'll do now is we'll just take our Fibonacci, swing high to swing low, Fibonacci retracement, swing high to swing low, bam, there we go. Pop our levels in with our horizontal line, make it a different color so it doesn't blend in too much with what we're doing here. Line number 1, line number 2, so line number 3, take that off. Now we're going to come in and look to see where is our most recent resistance points. Obviously we can see a couple forming here. So this is one area that we want to look at for stop loss. Another area being here. Pretty good risk to reward ratio. Well, this is going to be a little different because we're actually going to be entering sell stops as opposed to sell limits. Actually, let's take this a different way. This was an interesting move here. To be followed by that, this is actually looking bullish. Let's go back and see. So what I'm doing now is I'm actually going back to see what were some news events that came out of New Zealand in the last week or so, or the last 2 weeks that would have moved this. Okay. Taking this as well. Okay, we did have a rate decision not too long ago for NZ or for Australia. Alright. So we're going to take these down. We're going to look at this up differently. Alright, so for this we're actually going to only have one entry because we are at the 78.6, and usually the only reason you would ever use the 78.6, and I'll show you because it's going to be more prevalent on the Ichimoku, is if you're seeing sell signals closer to that level. If it hits the 100% retracement, that's not a safe bet. That's not a safe entry to get into. But if you're sitting close to the 78.6 or on the 78.6 like we are right now, and you're starting to get if you're starting to enter, we can see that this is a very, very bearish symbol, but we're seeing it trending higher. It's safe to say that this price could potentially drop to this area here, but now that we're looking at this, it's definitely safe to say that this has a high potential to continue higher. strong uptrend, actually. Yeah, if you're looking right here, this is a very strong uptrend since July 25th. So we're going to actually go bullish on this. And see, this is why it's great to always cross-correlate. Because if you know two pairs are closely correlated and you're trading AUD USD and NZD USD, you can see here, that you're going to get some, a better read. And that's the way, that's the reason I love using Fibonacci's and I love using Ichimoku, because there's so many points of confirmation, so many points of, analysis that, you'll, at one point, if something doesn't look right after you've used it long enough, you'll notice some things don't look right. If you look at them long enough, you'll start to see and say, okay, something's not right. So for instance, when we came in, and drew our Fibonacci from swing high to swing low, I'm saying we're going to use sell stops, but then we're looking and we use our Ichimoku. You can see that this is starting to form that green cloud that I was talking about. And the fatter the green cloud, the more dominant the trend is. So you can see here, I'll draw it out again so you can see that we actually are starting to get, you can see this, that we had a fat red cloud, but then an even, longer, equally as long, green cloud is starting to form. And you remember I was saying, these serve as supports and resistances. So right now we're seeing that right at this green cloud, that this would in fact be, if we're using our Fibonacci, if we're drawing it right from here, right up to the swing high, you're seeing that right in this cloud, we're getting Fibonacci levels and retracement levels right at these areas here, you can see. So this is a safe bet to say we're going to take this long. Just setting up the order, this is how we would do it. Set up a buy limit there. Buy limit there. And then a buy limit here. And if you're not using the Xstation platform, it is, it is safe to say that you probably can't enter your positions as easily. I recommend getting the Acclimation platform. If you don't have it, just contact one of us in Acclimation Trading Academy. We can help you with that. It's a very simple, easy to use platform. Many of us use it, and it works wonders. So now for the retracement, we did that. Now we're going to do our our Fibonacci expansion, and it works the same way as you do it when you're going short. You're just taking it from swing low to swing high, bringing it back right here to our first level, saying, okay, this would be where we take profit. This, bring it back a little more. You always want to keep everything nice and tidy. Set that take profit there. Come back down here. Set that take profit right here. There you go. Alright. And then for the stop loss, you just come in and say, if it drops below this area here, you get out. It's just because this would form what's called a cloud. Not the cloud, the Ichimoku cloud, but there's an actual formation where it's called a cloud, where, it's trying to search for a top, and it forms this, big gap, kind of like this area here, and then it drops lower. So then we'd come in here and just place our stop loss right there. One really quick thing I'm going to teach you guys. Some of you can use it if you want. If you don't want to use it, you don't have to if you don't feel comfortable. But a way of, instead of setting a stop loss, another way to do well with this, and I did it scale into this position. I just used equal positions. I used standards for each of these positions. Another way to get into, instead of setting a stop loss down here at this, 71.24.4, we can simply just come in place a sell stop for 3 standards. So as soon as we get to that point, we're essentially, just averaging out. Remember, it was 71. I think it's 244. Yeah, 244. So when we get to this point, instead of having our stop losses taking us out of an order, we're still going to be in, because sometimes what happens is we could get the market coming all the way back down here, take out our profits for our sells, and then it bounces back. Something crazy like that. If you're a little closer, you want to set a sell stop here, just to cut your losses, but it's going to continue bullish. But if it comes to here, it has a potential to come all the way back down here. Why not catch, how many pips is that? Yeah, about 122 pips. Why not catch 122 pips to this next resistance, or this next support rather, for then it bounce back up instead of getting out of these positions in loss. So that is another way of, getting out of an order, or averaging in, or locking your losses so that they don't exceed. For instance, if I came in and placed a sell now, and it went up, and it went down, and then I placed a buy, I'd lock in profits. The same works for when it goes into loss. So if I place a sell here, goes up here, I place a buy. Now, no matter what way it goes, I'm gonna lock in those losses, and that's good for right before big news. If you have open positions and you don't want to close them, or right before the weekend, if you're going into the weekend and you can get hit by a weekend gap, you want to lock in your just in case it goes one way or the other, you can get it. So those are some more high level tactics to use, but definitely that's the way we'd get into this order. Looking at NZD USD now, there are some things that might throw the correlation on this off, being that there was a rate decision in New Zealand not too long ago. There was a big rate decision that came out which affected the pair's correlation with Australia, because they are 2 different countries. So yeah, that's that. We're right at about 15 minutes left. So I'll just open it up to any questions.